Hello, and welcome to the Geopolitics Explained podcast. Yesterday, we saw Trump and Xi meet in Beijing. It's this that we'll discuss next episode on Tuesday. But for now, the conflict in the Middle East seems set to continue unless a miraculous deal can be agreed. There were some rumours prior to the Trump-Xi meeting that there could be some deal involving advanced semiconductors being sent to China in return for China helping push Iran towards a deal. This was implied by Trump saying that China needed to, quote, open up. And it was also implied by the number of tech leaders that accompanied Donald Trump on Air Force One. In the aftermath of the meeting, it does appear that China will be helping to support the push towards a potential deal coming out of the Middle East and the Strait of Hormuz. But the one wildcard in this situation is Israel. The Israelis have recently stated that they are ready to escalate against Iran once again, and that the conflict won't stop until regime change and the seizure of Iran's physical enriched uranium has occurred. We'll discuss this in more detail next time, but for now, based on the current rhetoric of the Israelis, we will assume that this conflict will continue even if a deal is reached between Iran and the United States, because Israel continues to imply that this will occur. If we assume that this conflict will continue, then we will continue to see economic ripple effects that we discussed last episode come out of the Middle East. Even if the blockades in the Strait of Hormuz were both withdrawn, that being the US blockade and the Iranian blockade, energy infrastructure would remain a likely target of strikes if the Israelis and the Iranians were still fighting. Also, any energy infrastructure that has been hit previously cannot be repaired overnight. This will take time. So the main point here is that the longer that these effects of conflict in the Middle East remain, the deeper the economic pain that could be felt on a global scale. And so today, we'll ask how these effects will follow through into inflation and growth. Will these issues remain isolated to the Middle East, or will there be a global consequence of this war? We'll first begin by discussing inflation. The conflict in Iran will lead to supply-side inflation. This is yet to follow through to the GSCPI, which tracks supply chain disruption, but there's been a clear drop of crude production coming out of OPEC, and we've already seen the effects of the war in the Middle East in recent inflation data. Year over year in March, the United States' inflation rose to 3.3%, largely driven by gasoline prices jumping 21.2%, and the overall energy index jumping 10.9%. Also, price rises in crude oil have led to a 10.7% drop in consumer confidence. This has largely been driven by reduced supply expectations, higher shipping costs, shifts in stockpiling behaviour, refinery bottlenecks, and financial market activity. UK inflation also rose to 3.3% year over year, driven by fuel price rises. Food inflation is also expected to rise dramatically as fertiliser trade restrictions coming out of the Gulf will affect the next harvest after reserves have been depleted. Also, shipping being disrupted will soon catch up with us. Tankers that departed the Persian Gulf before this conflict started at the end of February have now reached their destination, and so new consistent shipments of crude and finished products won't be flowing to the usual destinations. This trade friction is a part of the shift away from globalization, which itself is an inflationary trend on the supply side. The effects of this energy supply chain disruption will be felt differently depending on the energy portfolio of any nation in question. The key effects will be determined firstly by how a nation responds to these energy disruptions, secondly to whether a nation is a net importer or net exporter of energy, and finally how persistent the price rises across the energy sector are. Currently, the conflict and the blockades in Hormuz seem to be persistent. How this translates to prices is driven by multiple aspects of the crude industry. We recently saw the UAE leave OPEC to boost its own production, which could drive prices lower if this was an isolated event occurring outside of this period of conflict. But that's not the case. And so, with this conflict not yet over, we are susceptible to escalation once again, which could lead to further crude price spikes. Core inflation will also be an important metric to monitor here because it excludes food and energy. If core inflation begins to rise, then the effects of this conflict in Iran will have followed through to other areas of the economy. Other commodities heavily affected by the blockade of Hormuz, including helium, urea, ammonia, and aluminium, feed through into energy prices, but they also affect other sectors such as plastics. If these trade disruptions drive through to economies around the world, it will provide another potential supporting wind for rising inflation. It's also worth asking if we could potentially see this translate to liquidity issues. Higher energy costs, trade disruption, reduced credit availability as banks are tightening lending, and higher financial volatility can all contribute to liquidity stress. This has been seen in private credit, where firms are capping withdrawals as requests surged in the first quarter of 2026. Also, dollar shortages led PIMCO to lend $10 billion to the Middle Eastern states a few weeks ago. Today, there are many shifts occurring in the background, and they are inflationary in nature. The longer this conflict lasts, the longer these vital supply chains will be disrupted, and the deeper the eventual damage could be. So, with these inflationary pressures being seen in energy and food especially, how will growth be impacted? Now, when it comes to growth, we need to discuss the potential for a recession to occur. A recession is defined as 2 or more quarters in a row with negative economic growth. Currently, many of the recession indicators that we typically monitor don't yet reflect the changes that have emerged coming out of the war in Iran. For example, the SARM rule is calculated by using a 3-month moving average of the national unemployment rate, and so the effects of this haven't yet followed through. Other indicators, such as real personal income, industrial production, ISM manufacturing, and non-farm payrolls, are yet to show any effects from the Iran conflict if they do follow through to the United States. However, one indicator that has seen change is the spread between the US 10-year bond and the US 2-year bond. The spread hit a recent peak of 0.74 on February 9th, and it then fell to 0.46 on March 19th, and again on March 26th. But despite this decrease in the spread, since March 26th, the spread has actually been widening once again. Typically, a negative spread indicates that low growth is expected, which would imply that the economy in general is fearful of a recession. A positive widening spread, as we're currently seeing, implies that this isn't expected in the United States. However, the spread between the 10-year and the 2-year is also affected by inflation expectations, monetary policy expectations, flight to safety, and the Federal Reserve's undertaking of balance sheet operations. Higher inflation expectations typically lift longer-term yields, which widens the spread between the 10 and the 2-year. So, if the spread between the 10 and the 2-year is rising, this implies that inflation expectations are the dominant force, while if the spreads fall, flatten, or turn negative, this implies that falling growth and recession fears would be the dominant force. So for now, inflation is expected because we can already see it has arrived. However, the follow through to growth is not yet being expected by market participants in US bond markets. But the US is one of the strongest global markets. It maintains a strong labour market, deep capital markets, a large landmass upon which it can grow food, and an energy system that is adaptable through shale and large stockpiles. The US also has the dollar as global reserve currency, and so they can intervene with subsidies and fiscal support. The rest of the world isn't so lucky. When it comes to taking global growth collectively, A global growth percentage rate of 2% is often seen as the level that is associated with a global recession. If the war disruption in the Middle East fades within the next few months, the IMF expects that 2026 global growth will be 3.1%. This is over a percentage point higher than the 2% that is typically associated with a global recession. But this is the best case scenario. If there is a prolonged disruption where oil prices are at $100 on average in 2026 and $75 on average in 2027, then the IMF has a global growth forecast of 2.5%. And for the worst case scenario, if there is a persistent shock and if oil prices remain elevated at $110 as we head into 2027, the IMF predicts a global growth percentage of 2% for 2026. Nations that are sheltered from the disrupted energy and energy product supply chains will be the best adapted to manage the inflationary pressures through pre-existing stockpiles or through rising revenue from exports. Russia benefits from this, as do the Saudis through their exports through Yanbu and the Red Sea. In turn, this could see these nations resilient to the negative growth trends that are expected per the IMF. The advantage of these nations is that their market share over the energy supply chain gives them options and resiliency. However, nations that rely heavily on the import of these energy products or that don't hold sufficient reserves are vulnerable to this supply chain disruption. Inflation risk and recessions are much more probable for these nations due to shortages and rising fuel and food prices. Europe, due to its energy dependency, industrial weakness and weak growth, is very susceptible here. But the biggest issue is for nations that possess high government debts or low purchasing power. They will be outbid by nations with more purchasing power on necessities such as crude oil, liquefied natural gas, fertiliser, helium, and aluminium. Ultimately, some nations are under much greater threat than just inflation or recession. They are under threat of a lack of access to necessities. And this should be the biggest issue that we are considering as we look at the effects coming out of the Middle East. It's clear that there are still things that are shifting in the background when it comes to the conflict in the Middle East, and many questions remain. But the next potential shift in this current environment could occur in the next few days in the aftermath of the meeting between Trump and Xi. Hopefully, the next few days will provide some answers that we can then discuss in next episode. That's all for today. If you enjoyed this episode, please consider leaving a review on the podcast platform of your choice. It really helps out the podcast. I've been Dylan, and I'll talk to you next time.